Swing Trading. Chapter 6, Breakout Trading for Swing Traders. A breakout setup begins with a price level the market has already shown respect for. Maybe price has stalled there several times or reversed sharply each time it reached that area. For swing traders, that matters because it tells us buyers and sellers already recognize the level. When price finally pushes through it, the market may be shifting from balance into movement. A break above resistance suggests buyers are gaining control, while a break below support suggests sellers are taking over. The important idea is that a breakout is not just movement through a line. It is price leaving an old range and potentially starting a more directional swing. Support and resistance are the barriers that make breakout trading possible. Resistance acts like a ceiling where rallies have struggled, and support acts like a floor where declines have found buyers. Those repeated reactions show us where the market has been in temporary balance. When price finally closes above resistance, it can signal that buyers are strong enough to overcome that ceiling. When price closes below support, it can signal that sellers are pressing through the floor. This is why traders pay close attention at these zones. A breakout is really about the changing balance between supply and demand at a visible level. The quality of any breakout depends heavily on the quality of the level you choose. A level that has been tested multiple times usually has more meaning than one created by a single random reaction. That is why swing traders often begin by marking recent highs and lows and then asking whether price respected that area more than once. Clean horizontal levels or zones are usually easier to work with than messy, overfitted lines. Repeated touches matter because more traders are likely to notice them, and that shared attention can make the breakout more important. Round numbers can also add weight when they line up with those reactions. If the level is weak or unclear, the breakout built on it is usually weaker too. For swing trading, the daily chart is often the most practical place to start because it filters out a lot of intraday noise. A common mistake is reacting to price briefly trading above resistance or below support during the session. That move can disappear by the close, leaving no real confirmation. What matters more is whether the candle actually finishes beyond the level. A daily close shows that price was able to hold the breakout long enough to matter. It does not guarantee success, but it usually carries more weight than a quick intraday poke. Letting the session close helps you trade evidence instead of excitement. Candlestick structure helps you separate a real breakout from a short-lived spike. The body of the candle represents the move from open to close, while the wick shows the session extremes. A wick can travel beyond a key level and still fail if the body closes back inside the old range. That is why traders usually give more importance to the close than to the temporary excursion. If the candle body finishes clearly beyond the level, the breakout has more credibility. If only the wick pierced it, the market may simply have tested the area and rejected it. In breakout trading, the body tells you more about acceptance, and the wick tells you more about exploration. A stronger breakout tends to look decisive rather than hesitant. One thing to ask is whether the candle closed clearly beyond the level, not barely a few cents past it. Then look at what happened after that close. Did the next daily bar stay beyond the level, and did price extend far enough to show some real follow-through? Often around 1 to 2%, a healthy pullback can add even more confidence if the old resistance begins acting as new support, or old support becomes new resistance. These details help you judge whether price is truly being accepted beyond the level. Strong breakouts usually prove themselves by staying out of the old range, not by making a brief appearance above it. Not every breakout succeeds, and that is where false breakouts become important. A fakeout happens when price breaks the level, attracts traders into the move, and then quickly reverses back into the prior range. That quick return tells you the market did not truly accept the new territory. At the same time, it is also normal for a valid breakout to pull back and retest the broken level before continuing. So a pullback by itself is not failure. The key difference is what happens at the retest. If old resistance becomes support, or old support becomes resistance, the breakout still has a healthy structure. A simple breakout process keeps you from guessing too early. Start with the daily chart and mark a support or resistance level that is clear and tested. Then wait for price to actually approach that area rather than anticipating the move in the middle of nowhere. When price reaches the level, focus on whether the candle closes beyond it. After that, look for follow-through or a successful retest to confirm strength. This process sounds basic, but that is exactly why it works. It shifts your attention from prediction to confirmation, which is a much better mindset for swing trading. Imagine Solar Tech has failed twice near 48.75. That repeated failure makes the area a meaningful resistance level because the market has already shown you it matters. If price later closes at 49.20, that is the first sign buyers may have finally pushed through. If the next day also stays above 48.75, the breakout becomes more convincing because price is holding its new position. A trader could choose to enter on that confirmation, accepting a slightly later entry in exchange for more evidence. Another trader might wait for a pullback toward the old level and try to enter on the retest. Both approaches come from the same logic, let the level prove itself first. Most breakout mistakes come from impatience and low selectivity. Traders often treat every tiny move through a line as a breakout even when the level is messy or the move is insignificant. Another common error is entering before the daily close, only to discover the breakout disappeared by the end of the session. Some traders also panic at any pullback, even though retests are often normal and healthy. Just as important, a breakout should never be viewed in isolation from news, earnings, or the broader market trend. Clean levels and decisive price action matter more than constant activity. Good breakout trading is usually about waiting for fewer, better setups rather than chasing every move. With basic breakouts in place, we can move into one of the most useful continuation patterns, the flag. A flag forms after a strong directional move, then pauses in a smaller, controlled consolidation before often continuing in the same direction. That first sharp move is called the pull, and the pause that follows is the flag itself. In a bull flag, the pause usually drifts slightly downward after a rally. In a bear flag, the pause usually drifts slightly upward after a drop. The key idea is that flags are usually continuation patterns, not reversal patterns by default. They represent a brief pause in momentum, not necessarily the end of the trend. Flags often form because the market needs a short break after a fast move. Some traders who caught the initial surge take profits, while others who missed it wait for a cleaner pullback to get involved. That temporary balance creates a small consolidation instead of an immediate continuation. What you want to see is a controlled pause, not chaotic price action. In other words, the trend rests, but it does not fall apart. If the larger move still looks intact after the pause, the setup may be preparing for another breakout. This is why the character of the consolidation matters just as much as the strength of the initial pull. To recognize a strong flag, begin with the momentum leg. The pull is often a steep move that develops over roughly 3 to 10 candles, showing clear urgency from buyers or sellers. After that, the flag usually lasts around 5 to 20 bars and should look tidy rather than erratic. In a bull flag, the pause is usually a mild pullback after a rally. In a bear flag, it is usually a small bounce after a drop. The exact number of candles matters less than the overall character of the pattern. If it looks chaotic, rounded, or like a true reversal, it is probably not the kind of flag you want to trade. Once you identify a possible flag, the next job is to define its boundaries clearly. A pattern is only useful if you know exactly what level would complete it. In a bull flag, traders watch the upper edge of the consolidation for the breakout. In a bear flag, they watch the lower edge for the breakdown. You do not need fancy drawing tools to do this well. Simple horizontal reference lines often work better than overly complex trend lines because they make the trade decision easier and more consistent. Clear boundaries also help you plan the entry, stop, and target before the move happens. A flag is not complete just because price is moving around inside the pattern. The breakout needs confirmation. For a bull flag, that usually means waiting for a close above the top of the consolidation. For a bear flag, it means waiting for a close below the bottom. This patience helps filter out intraday fakeouts, where price briefly pushes beyond the edge and then falls right back in. As long as price is still inside the flag, the pattern is still unresolved. Waiting for the close may cost you a little entry price, but it often improves the quality of the trade. Volume can add an extra layer of confidence to a flag breakout. During the flag itself, volume often contracts because the market is pausing and participation is temporarily quieter. That is usually a healthy sign. When the breakout arrives, Stronger setups often show expanding volume as new traders step in and the trend resumes. Rising volume suggests renewed participation behind the move. Weak volume does not automatically invalidate the pattern, but it can be a warning sign that the breakout may not have much conviction. Volume supports the setup. It does not decide everything on its own. A strong pattern is only part of the trade. You also need a clear plan for entry, target, and stop. One common approach is to enter after the breakout bar has closed, then buy or short at the next open, depending on the direction. Many traders project a target using the height of the pole, which gives a practical measured move. The stop typically goes beyond the far side of the flag, so normal noise inside the pattern does not take you out too early. This structure gives you a defined reward objective and a logical invalidation point. The goal is not just to spot the pattern, but to turn it into a complete trade plan. Suppose a stock rises from 50 to 65. That 15-point move becomes the pole. Then price drifts in a controlled way between about 62 and 65, forming the flag. If the stock closes at 66, it has broken above the top of the pattern, and an entry at the next open around 60-66.10 becomes reasonable. A measured move target would project the 15-point pole above the 65 breakout area, giving a target near 80. A stop near 61 places it below the flag and beyond the normal pullback zone. This example shows how a visual pattern becomes a real plan with numbers attached to it. Once you're in the trade, the work is not finished. You want to monitor whether price is following through after the breakout or losing momentum quickly. Strong moves may justify taking some partial profits, especially if price covers a lot of ground in a short time. At the same time, you can raise the stop to protect open gains as the trade proves itself. That helps reduce the chance of letting a good breakout turn back into nothing. Trade management should stay realistic and disciplined. Even a well-formed flag still needs good handling after entry. Flag patterns fail for predictable reasons, and recognizing those reasons can save you money. Entering before the breakout is confirmed is one of the most common mistakes because it exposes you to a pattern that may never complete. Weak or unimpressive volume can also warn that the move lacks participation. If the flag drags on too long, the pattern may be losing its continuation quality and turning into something less reliable. Another mistake is confusing a true reversal with a simple pause in trend. And if the stop is too tight, even a healthy setup can shake you out before it works. Many bad outcomes come not from the idea of the flag, but from poor execution around it. A checklist can make flag trading much more consistent. Start by finding a strong directional move that clearly stands out on the chart. Then look for at least several bars of controlled consolidation rather than random, noisy action. Draw the breakout line clearly so you know exactly what must happen for confirmation. Compare breakout volume with flag volume to see whether participation is returning as the pattern resolves. Finally, calculate the pole, target, and stop before taking the trade. When you practice this process repeatedly, the pattern becomes easier to recognize and easier to trade with discipline. Price tells you what happened, but volume helps explain how much support was behind that move. Two breakouts can look similar on the chart while having very different odds of follow-through. A breakout on high volume suggests broad participation, meaning more traders are committing to the move. A breakout on low volume can still work, but it may be more vulnerable to failure or fake-out behavior. This is why price alone can sometimes be misleading. Volume does not predict the future, but it gives useful evidence about breakout quality. It helps you ask whether the market is truly pushing through a level or just drifting through it. A practical way to judge breakout volume is to compare it with the average volume of the prior 20 periods. That gives you a baseline for what normal participation looks like on the time frame you're trading. As a rough guideline, a breakout bar with volume around 1.5 times the 20-period average is often worth noting. If it is closer to 2 times average, or more, the move can look more convincing. What matters is keeping the comparison consistent. If you trade an hourly breakout, compare it with average hourly volume, not daily volume. These numbers are guidelines, not rigid rules, but they help remove some subjectivity from the process. The breakout bar matters, but the bars after it matter too. A healthy breakout often keeps participation reasonably firm over the next 2 or 3 bars, even if volume eases somewhat from the initial surge. That slight easing is normal. What you do not want to see is volume collapsing immediately back to average while price stalls right after the breakout. That kind of sharp fade can suggest momentum is already drying up. Follow-through volume helps confirm that the breakout is attracting continued interest, not just a one-bar burst. In other words, strong participation should not vanish the moment price gets through the level. Pullback volume gives you a second test after the breakout itself. It is very common for price to retest the level it just crossed. During that pullback, lighter volume is usually healthier because it suggests the move against the trend is not especially aggressive. If the pullback comes on heavy volume, that can warn that real opposition is stepping in. Then, if price turns back in the breakout direction and volume expands again, the trend resumption looks more believable. This same logic works in both bullish and bearish setups. The retest is not just about price touching the level, it is also about who is participating during that test. A repeatable volume checklist helps keep you from making decisions based on excitement. Start by finding the 20-period average volume for the chart you are trading. Then mark a clear support or resistance level so you know what the breakout is actually breaking. Compare the breakout bar's volume with that average, and ask whether participation is meaningfully stronger. After that, review the follow-through and any pullback to see whether volume behavior still supports the move. If volume is weak at the break or fades too quickly afterward, it is often fine to pass. Good traders do not need to trade every breakout they see. Consider a stock like Green Energy trading between 52 and 58 for about a month. That makes 58 a clear resistance level because the market has repeatedly stalled there. If the stock breaks above 58 on a 1-hour bar that trades 850,000 shares, while average hourly volume has been closer to 125,000, participation is dramatically above normal. That is nearly 7 times the average, which immediately makes the breakout more interesting. If the next few bars also hold above the level, the case becomes even stronger. Volume at that scale tells you the move is not just a quiet drift through resistance. It suggests strong momentum and broad involvement behind the breakout. Suppose that after the breakout, price climbs to 58.50 and then 58.80. If volume remains elevated at 700,000 and then 600,000 shares, that is a healthy sign even though it is lower than the initial breakout burst. Participation is easing, but it is still clearly strong. Then imagine price pulls back to 58.10 on only 150,000 shares. That lighter pullback volume suggests sellers are not especially aggressive. In many cases, that is exactly what you want to see after a breakout. Price is testing the move, but the opposing pressure looks modest rather than forceful. A trader looking at that setup might consider an entry around 58.30, once the breakout and early follow-through are visible. A stop below 57.90 would place risk under the breakout area rather than right on it. Partial profits near 60 could be reasonable because round numbers often attract attention and because the trade has already moved well from the level. But even with good volume, trade management still matters. Volume improves the odds. It does not eliminate the possibility of failure. That is why the setup still needs a stop, a target, and a plan for what to do if momentum slows. Good confirmation supports decision-making, but it never replaces risk control. Volume only helps if you interpret it in context. One mistake is trading price alone and ignoring whether participation actually expanded on the move. Another is treating a tiny volume bump as if it were strong confirmation when it really is not much different from normal. Some traders also forget to check what happened after the breakout, even though follow-through often tells you whether the move has real strength. It is equally important to match volume to the correct time frame, because daily and intraday comparisons are not interchangeable. And of course, even very high volume does not guarantee success. Volume is evidence, not certainty. One of the best ways to build this skill is to practice without placing trades. Find a stock that has been moving sideways for at least a couple of weeks and mark a clear resistance level on the daily or 1-hour chart. When price breaks out, record how the breakout volume compares with the prior 20-period average. Then, review the next 3 bars and any pullback that follows. Write down whether you would take the setup or skip it, and more importantly, why. Over time, this kind of observation builds pattern recognition without financial pressure. You begin to see the difference between noisy breakouts and those that attract genuine participation. After learning to confirm breakouts, the next refinement is learning to trade the retest. A breakout retracement or BOR setup waits for price to break a key level and then pull back toward it before entry. Instead of chasing the first surge, you let the market test whether the breakout is real. In a bullish BOR, old resistance may become new support. In a bearish BOR, old support may become new resistance. The actual entry comes only after that retest appears to hold. This approach is designed to trade confirmation and structure, not speed and emotion. Pullbacks after breakouts are normal and often healthy. Early traders may take profits after the initial move, while others who miss the breakout wait for a cleaner entry near the broken level. That combination naturally pulls price back toward the breakout area. By itself, that retracement is not a warning sign. In many cases, it is simply the market checking whether the new price zone will hold. If price revisits the area and then finds support or resistance there in its new role, that retest shows acceptance. The important question is not whether a pullback happened, but how price behaved during it. Many traders prefer BOR entries because they often improve the structure of the trade. If you chase the initial breakout bar, your entry may be stretched and your stop may need to sit farther away. A BOR entry often gives you a more controlled price near the retested level. That usually means the stop can be placed closer to the actual invalidation point, which can improve reward to risk. Just as important, it reduces the emotional pressure to jump in during a fast move. Of course, better structure does not mean certainty. Some retests fail, which is why the setup still needs confirmation and a stop. Not every breakout pullback deserves to be traded as a BOR setup. The best ones usually begin with an obvious level that has been tested multiple times, because the market has clearly shown that area matters. They also tend to work better when the broader trend supports the direction of the breakout. A decisive breakout is another positive sign, because a weak, hesitant move is less likely to hold on retest. Moderate volatility also helps. If price is wildly erratic, the retest becomes harder to interpret and harder to manage with a sensible stop. BOR works best when structure, context, and behavior all line up. First step in a board trade is the same discipline we used earlier. Start with a meaningful level and confirm the breakout. On the daily chart, that means choosing a support or resistance area that is obvious and has multiple prior tests. Avoid random lines that only make sense in hindsight. Once price reaches the level, wait for a clear daily close beyond it rather than reacting to a brief intraday move. Strong volume can add confidence, but the close itself is the key evidence. If the breakout has not been properly confirmed, there is no BOR setup yet. The retest only matters if the original break was real in the first place. After the breakout, the job shifts from acting to waiting. Price may drift back toward the broken level over the next several bars, and this is where many traders get impatient. In a bullish setup, you generally do not want to buy while the pullback is still actively falling. In a bearish setup, you do not want to sell while the rebound is still rising. Instead, watch for price to stabilize near the level. Small candles, slowing momentum, or evidence that the move is being absorbed can all be useful clues. The BOR entry comes after the pullback starts losing force, not while it is still pressing toward you. The central question in a BOR setup is simple. Did the retest hold? In a bullish example, you want old resistance to act like new support. In a bearish example, you want old support to act like new resistance. Small intraday overshoots are not always a problem because markets do not respect lines with perfect precision. What matters more is whether price closes decisively back inside the old range. If it does, that is a warning the breakout may be failing. A healthy BOR usually pauses near the level, rejects the old range, and begins turning away from it. Once the retest appears to hold, you can build the trade around confirmation and risk control. A common trigger is a bounce from the level or a strong closing bar that moves away from it. The stop typically goes just beyond the level with a small buffer, so the trade has room for normal noise, but not enough room for the setup to fully fail. For a target, many traders project the height of the prior range in the direction of the breakout. That creates a logical measured move rather than a random exit point. The BOR setup is attractive because the entry, stop, and target all come from the chart structure itself. The more clearly that structure is defined, the easier the trade is to manage. Imagine a stock has traded between 50 and 55 for 3 weeks. That makes 55 a clear resistance level. It then breaks out and closes at 56.50, which confirms the move beyond the range. A day later, price dips to 54.80 but recovers to close at 55.30, suggesting the old resistance area may be acting as support. An entry near 55.50 after that bounce gives you a more controlled price than chasing at 56.50. With a stop at 54.40 and a target near 60 based on the 5-point range, the structure becomes clear and measurable. To get better at BOR setups, review charts in a structured way. Look for levels that were tested multiple times so you can separate meaningful breakouts from random ones. Mark the breakout itself, the pullback into the level, and then the first close that moves away from the retest. Also note whether the broader trend supported the setup and whether volume behavior helped or hurt the case. Did the level hold cleanly or did price reclaim the old range? Journaling these details helps you build pattern recognition much faster. Over time, you start to see which retests were healthy and which were weak, long before the outcome is obvious. Most BOR mistakes come from impatience or poor context. Traders often enter before the pullback has actually confirmed, which means they are still guessing instead of responding. Others ignore the broader trend and try to force BOR trades in directions that do not have much support. Stops that are too tight can also create unnecessary losses, especially when normal retest noise is enough to tag them. Another mistake is treating every retest as valid, even when the original breakout was weak or the price action is messy. Volume matters here too, because a weak breakout or heavy opposition on the pullback can change the whole picture. BOR works best when patience, clean structure, and trend alignment are all present. A breakout can create an excellent swing trade, but only if you also know where the trade is wrong. That is the job of the stop loss. If price breaks out and then falls back through the area that was supposed to hold, the original idea may no longer be valid. A stop gives you a planned exit before the trade turns into a much larger problem. It defines your risk in advance, which is one of the most important habits in trading. It also protects capital by keeping a small loss from becoming emotionally difficult and financially damaging. In breakout trading, the stop is not a detail after the fact. It is part of the setup from the beginning. Traders usually avoid placing a stop exactly at the breakout level, because that area often gets retested. When resistance breaks, it can become support, and price may come back to check that level before moving higher again. If your stop is placed right on the line, a normal retest can knock you out even when the trade is still healthy. Placing the stop below the level gives the chart some room to behave normally. The idea is to define failure, not react to routine noise. If price loses the level decisively, then the breakout may truly be breaking down. A stop below the level is meant to reflect that difference. There is always a balance between giving the trade enough room and protecting yourself from unnecessary loss. If the stop is too tight, normal pullbacks and random volatility can trigger it before the trade has a chance to work. If it is too wide, a failed setup can cost much more than it should. The goal is to place the stop at a meaningful invalidation point, not at an arbitrary distance. In practice, that often means using chart structure, such as a swing low or support zone, together with volatility. Structure tells you where the idea is wrong, and volatility tells you how much noise is normal. Combining both usually leads to better stop placement than relying on only one. One useful tool for estimating stop distance is ATR, or average true range. ATR measures how much a stock typically moves over a given period, so it gives you a sense of normal volatility. A 14-day ATR is a common setting for swing traders. Stocks with a high ATR tend to make wider daily moves and usually need a larger stop buffer. Slower, quieter stocks can often use a tighter one. Many traders use a multiple of ATR, such as 1.5 times ATR, to create that buffer below the breakout level. ATR does not tell you direction, but it does help you align the stock with the stock's normal behavior. Here is a simple stock calculation using ATR. Suppose the breakout level is $100 and the 14-day ATR is $2. If you choose a buffer of 1.5 times ATR, the buffer becomes $3. Subtract that from the breakout level and your stop price becomes $97. This method gives you a clear, repeatable way to place the stop below the level instead of guessing. It also helps standardize your process from one trade to the next. The key is that the stop is based on both the chart level and the stock's volatility. Let's apply that idea to a breakout in TechCorp. If resistance breaks at $75 and the 14-day ATR is $1.20, then a 1.5 ATR buffer equals $1.80. Subtracting that from 75 gives a stop at 73.20. That means your initial risk is $1.80 per share. If price continues higher, the trade remains active and the stop can be managed later according to plan. If the breakout fails and price falls to 73.20, you exit with the loss already defined. This is the value of a volatility-based stop. The trade risk is clear before the trade begins. The distance of the stop changes both your experience in the trade and the amount you stand to lose if wrong. A stop at 74.90, just under a 75 breakout, might look safe, but it may be so tight that a routine pullback triggers it. On the other hand, a stop all the way down at 70 is probably giving the trade far too much room. That wider stop may reduce shakeouts, but it also increases the loss if the idea fails. The goal is not the tightest stop or the widest stop. It is the stop that best fits the stock's volatility and the logic of the setup. Good stop placement is always a balance, not an extreme. Stop placement is only part of the job. Stop management matters too. Before you enter, the initial stop should already be defined, and one rule is especially important: do not move the stop lower just because the trade is uncomfortable. That usually turns a planned risk into an emotional one. As the trade works, you may raise the stop to reduce risk or protect profit, but those adjustments should come from a plan, not from fear. In other words, improving trades can earn tighter risk, but struggling trades should not be granted more room after the fact. Discipline in stop management is often what separates controlled traders from reactive ones. Several stop-loss mistakes show up again and again. One is placing the stop exactly at the breakout level, where normal retests often occur. Another is using the same stop distance for every stock, even though volatility can differ dramatically from one chart to another. Some traders choose a stop with no real chart logic behind it, which makes it hard to know whether the trade failed or the placement was simply random. A particularly harmful mistake is widening the stop after entry because price moves against you. That changes the original risk without improving the setup. Better stops are intentional, volatility aware, and tied to structure. The best way to make this process practical is to use it on real charts. Mark a breakout level on a current or recent setup, then check the stock's 14-day ATR. Calculate both a 1.5 ATR stop and a 2 ATR stop below the level. Then compare them against the chart and ask which one gives a better balance between protection and breathing room. The answer may differ from stock to stock. This exercise helps you see that stop placement is not random and not one size fits all. Over time, the combination of structure and volatility becomes much more intuitive. After the entry and the stop are defined, the next question is how to take profits without giving up all your upside too soon. Breakout trades often move strongly at first, then pause, pull back, or become more erratic. Taking partial profits can help you handle that reality. Instead of exiting the entire position at one level, you sell part of it to lock in gains while keeping some shares for a larger move. That can reduce pressure and lower the emotional weight of the trade. It also acknowledges that many breakouts are not straight-line trends. Partial profits are really a compromise between protection and participation. Partial profit decisions usually work best when they are planned before the trade even begins. Start by deciding your total position size and your stop loss so the risk is clear. Then choose a first target, a second target, and whether you want to keep a final piece open as a runner. Making those choices in advance keeps you from improvising during fast price movement. It also helps you stay consistent from one trade to the next. Once the breakout is underway, emotions tend to get louder and decision quality often drops. Pre-planned exits help keep the trade mechanical when the market becomes exciting. There is no single correct way to split a position. Some traders like a simple 50-50 approach, selling half at the first target and the rest at the second. Others use thirds, taking 1/3 off at the first objective, another third later, and letting the final third run. Another common method is selling half at the first target and then managing the remainder with a trailing stop. The right choice depends on your style, your tolerance for volatility, and how actively you want to manage trades. What matters most is keeping the method simple enough to repeat. A plan you can follow consistently is more useful than a perfect plan you abandon under pressure. A practical way to build targets is to start with your original risk. If your entry is 50 and your stop is 48, then your risk is $2 per share. A first target at 1-to-1 reward to risk would be 52, which is a conservative objective. A second target at 2-to-1 would be 54, and you might even aim farther if the chart supports it. This approach gives the trade structure because both targets come from the same initial risk. The first target is there to book something reasonable. The second target is there to let a winning breakout produce a larger payoff. Once the first partial sale happens, the trade changes. You have already realized some profit, so the remaining shares can usually be managed more defensively. Many traders move the stop on the remaining position to break even or slightly above entry, depending on the plan. That reduces or removes the original risk while keeping some upside exposure. The important thing is to follow the plan rather than rewriting rules in the middle of the trade. Booked profit can improve flexibility, but it should not create random decisions. And remember that break-even is not perfectly break-even once fees and slippage are considered. If the breakout keeps working, the remaining position gives you choices. You may sell another portion at the second target and then decide whether the trade is complete. Or you might leave a final piece open to capture a larger swing move. In that case, a trailing stop can help protect gains while still giving the trade room to continue. This is one of the biggest advantages of scaling out. You walk in profits along the way, but you do not completely cut yourself off from a strong trend. The position becomes smaller, but the upside remains alive. Partial profits only apply if price actually reaches the planned target. If the breakout stalls early and never gets there, there is no reason to force an early sale just to feel active. Until the first target is hit, the original trade plan remains in place. That means the original stop still matters. If price fails and hits that stop, the trade simply ends as planned. Good scaling can improve how you manage a winning trade, but it does not rescue a weak setup that never worked. The quality of the entry and the discipline of the stop still come first. Imagine a breakout trade with an entry at $80.50 and a stop at $79.50. So the risk is $1 per share. If you buy 300 shares, a simple 3-part plan becomes easy to map out. You could sell 100 shares at $81.50, which captures 1-to-1 reward to risk on that portion, and then sell another 100 at $83.50 as the trade extends. The final 100 shares can remain open with a trailing stop in case the breakout develops into a larger move. This kind of structure reduces risk early while preserving upside if momentum continues. That same example shows why scaling out can feel more manageable psychologically. The first sale earns $100, the second sale earns $300, and the final sale at 86 produces $550 more. Total profit comes to $950. If you had sold all 300 shares at $83.50, the total would have been $900 instead. So the partial profit plan not only reduced stress along the way, it also left room for a slightly better overall outcome. Of course, that will not always happen, but the example shows how partial exits can balance certainty and opportunity in a realistic way. Partial profit strategies can lose their value when they are used carelessly. One mistake is selling everything at the first target and leaving no position for a larger move. Another is taking a partial sale but never adjusting the stop on the remaining shares, which leaves too much risk on the table. Targets that are too close together can also weaken the plan because they do not give the trade room to develop. And many traders start well, but rewrite the whole plan mid-trade once emotions take over. Scaling out works best when it is connected to a solid setup, reasonable position sizing, and a defined stop. Without that foundation, partial exits become just another form of improvisation. A good way to practice this is to build a complete partial profit plan on a recent breakout chart before any money is involved. Suppose you are willing to risk no more than $200 on the trade. If the entry is 50 and the stop is 49, your risk is $1 per share, which means a position size of 200 shares. You might plan to sell 100 shares at 51, then move the stop on the rest entry. After that, You could target 52 or trail a smaller final piece if the breakout remains strong. The math is simple, but the habit is powerful. When you plan the shares, targets, and stop adjustments in advance, your trade management becomes much calmer and much more consistent.